Listen, we're going to start with our first topic, which is really about the CEBA loan repayment options. So there are many who have taken the CEBA loan, and just as a refresher, that's the Canada Emergency Business Account. It's a pandemic initiative that it's maxed. It has maximums, but it's government backed, interest free, and the max was 60. With a forgivable amount of up to, if you had 60, it's 20, so 33%. I'm not going to get into the detail, and certainly there's a lot of information on it at the official website, which is CEBA.ca. But also chatting with your advisors could be helpful, and I'm sure you've been doing that for some time. And I know that everyone was waiting to see if there would be any great news about forgiveness of the total loan, but certainly what we got was something a little different. And so just to give you a bit of an update, if you haven't already heard or didn't understand what it meant, the repayment deadline was December 31st, 2023. So that's straight in front of us, and it has been extended to January 18th, 2024. And that's a really important key date, because that repayment date is really in order to not compromise the maximum forgivable portion of the loan that you do have. Then the interest-free period is going to end after January 18th. So that's another thing. The 0% will start charging interest at a 5% interest rate, and the loan will be a two-year term loan. So due December 31st, 2026. So there was also an extension there. So if the opportunity to preserve the forgivable amount is lost. So if for some reason the loan does not get repaid by that time, and you do enter into a term loan at 5%, I just wanted to give you some practical matters in real dollars what that might look like. So the overall cost of that $60,000 received under CEBA, under those repayment terms, is probably more than about $68,000 at the high end, versus the $40,000 if it had been paid on time, realizing the $20,000 forgivable portion. So, and I know the 5% interest rate seems attractive in current times, but giving up the 33% debt forgiveness is still a great incentive to pay on time. So there's a variety of repayment options. And Josh, I know part of this is really going to be dependent on people's liquidity to repay the loan by those dates. Did you have any ideas that people might be wanting to consider relative to their cash flow?
Yeah, thanks, Natalie. Yeah, I mean, certainly there's a lot of financing institutions out there that are having marketing campaigns, reaching out and saying, hey, your CEBA loans are coming due. Work with us, we'll convert them to a loan of some kind. And if you're not in a position to repay the CEBA loan, I'd recommend exploring those options, because obviously, if you can convert that financing to another form of financing, you won't have to repay that 10 or 20,000, depending how much you got that you did not have to repay. That being said, if you don't end up doing that and you end up converting the CEBA loan to a regular loan, the portion that you had previously gotten that was forgivable, if you did things correctly, you had to pay tax on that amount. So if you end up keeping those funds as a loan, then that 20,000 at least you'll be able to deduct that amount if you end up converting that into a loan and not repaying it. But it's obviously better to repay it and end up with a different financing option if you can. With that, we'll move on to our next topic. So using capital losses. So this is typically the time of year that your investment advisors may reach out to you, and certainly in a down year. In the good years, they're telling you what the great returns were that they had for you. In a down year, they'll be reaching out to you, telling you, hey, there's an opportunity to do some tax loss selling to offset things. Now, that may be the case. Certainly would recommend that you speak with your advisor before immediately triggering any losses. The first point up there talks about optimizing CDA. What CDA stands for is capital dividend accounts. So those with a corporation, anytime you sell an investment, 50% of the gain is not subject to tax and goes into this capital dividend account. That can be paid out tax-free with the filing of an election form. The only issue is that any capital loss incurred reduces that capital dividend account balance that can be paid out tax-free. So if you were considering triggering capital losses, you had a balance in that capital dividend account, you would want to speak to your accountant, see what needs to be done to get that election filed and declared and paid prior to realizing the capital losses, which could then still be used to offset any capital gains that you've incurred. And we say paid, I mean, it can be declared, it can be paid and loaned back to the company. So it's not that the funds necessarily have to come out to you if the company doesn't have the available cash flow. Capital losses in general, just a couple of points that capital losses can be applied only against capital gains, and they can be carried forward indefinitely, but again, only applied against capital gains. And there's also an ability to carry back losses up to 3 years, possibly for a refund of taxes if you paid taxes in that time period. And so, Natalie, do you have any other points on that slide?
Just, I mean, this is a lot of information and it's a bit of strategic planning, and it's not something that you're going to be doing on your own typically. And so just it's really helpful, just speaking from an accountant's perspective and business advisor, to put your investment advisor in touch with your accountant. Strategically, they both have pieces of information that need to contribute to the planning and can really maximize quite efficiently on your behalf the best timing and approach to do so. So maximizing the benefit of the capital dividend account, tax-free money, versus, or in combination with minimizing corporate taxes in the same year if appropriate. Okay. I think we can head to our next slide. Considerations for immediate expensing. And again, immediate expensing has been around for a little while. And the reason we're bringing it up today is because it's coming to an end. So the window is closing, and it's a short window in front of us now, but I want to talk about it just briefly because we've still got some time ahead of us. So we've got a really great article up on our website now. That's it's a new article talking about this, and so I think we can probably post it in the comments. You can grab it and have a look at it, read it at your convenience. But just a reminder about what the program is. So it's tax incentive program for, let's say, CCPC. So that's Canadian Controlled Private Corporations. And in order to qualify for the, again, immediate expensing, so 100% of a capital cost being deducted as a capital cost allowance for the new asset in the current year, is that the asset must be purchased and available for use before the end of December 31st, 2023. So it's one thing to have a commitment to get something, but if you don't actually have it delivered and in use before that period of time, it will put you offside in terms of what their qualifying rules are. So it's a really, in terms of like what assets might qualify, it's a very, very broad reach in terms of what does qualify. It might actually be easier for me to tell you what does not qualify, and keeping in mind that there's, again, these restrictions are a bit few, but the capital cost amount is quite large. So if there are any long-lived assets that you're considering purchasing, buildings, fixing roads, or intangible assets even, such as goodwill, so those things that last a really long time, they would not qualify for immediate expensing. So if you're thinking of, cars in the business, or equipment, computers, that sort of thing would definitely qualify. So if you're considering making a capital purchase in the near future and you're debating about, should I do it in 2023 versus should I do it in 2024? If you want access to the immediate expensing deduction, if that's what's valuable to your business because you've had a really profitable year, then you would want to make that purchase and have it available in 2023 before the end of the year. I think this is, it can be a bit, it's strategic, certainly. And I've talked about it from the positive side, but I imagine that there's some pitfalls too, or some helpful tips. Josh, I was just wondering if you had seen anything or heard of anything that people should sort of be aware of.
Yeah, thanks, Natalie. I mean, one thing I'd caution against is just understanding the difference between the accounting and tax treatment of capital leases. So you may think, if you've entered into a lease, with a bargain purchase option at the end, but you're making regular lease payments over the course of the lease, You may think, from an accounting perspective, you may say, okay, well, I'm buying this asset. And you may think I'm buying this asset, but I believe that does not qualify for immediate expensing. That's a leasing arrangement until you actually have ownership of the asset at the end. You don't own it. So in that case, what you would be deducting for tax purposes would be the lease payments that you're making, plus any interest on the financing costs for the capital lease. But and then, as I said, that could be one that might catch you by surprise if you think you're accessing the immediate expensing rules. If we move to the next slide. Sorry, I think you went forward, and you went one too many. Thank you. Okay, grants and incentives, including zero emission vehicles. So the government certainly put out some things to encourage people, towards using zero emission vehicles. This is in place for any emergency zero emission vehicle purchase between March 18th, 2019. That'll be in use to January 1st, 2018. There's some benefits to it in that the amount that you can claim as a deduction for tax purposes is increased significantly in comparison to regular vehicles, and also the limit on the vehicle. So typically a limit, the government puts a cap on the amount of a vehicle that can be deducted, what they call luxury vehicles. So a regular vehicle's maximum amount that can be deducted over time is $34,000 plus the sales tax. For a zero emission vehicle, that limit is extended up to $59,000 plus sales tax. And as I say, the deduction amount that you can claim each year is a larger amount under this program. One thing I would certainly caution against, for those looking to do this in your corporation, because we're often asked this question, say, okay, I'd like to buy this car in my corporation. There's still the issue whether it's for business use or personal use. So as a general rule, my general advice to clients is, unless the car is going to be used more than 50% for business purposes, you're better off just owning it personally and getting reimbursed from the corporation for any mileage incurred. To the extent a corporation owns a vehicle, regardless of whether it's a zero emission vehicle or otherwise, and using it for personal use, there's can be somewhat complex taxable benefit calculations that are to be reported for that personal use of the vehicle, and so that can make things a little more tricky. Natalie, I don't know if you have anything further to add on this.
Yeah, I do. And you're more generous than I am. I always say if it's not 90% or more, please don't. This my tolerance for the administrative and the complication is lower than yours. So I did want to also add to the cautionary tale, and this is not so much about the EVs, except that the purpose of getting the EV is not just because the car is cool, but because also you want to contribute and be a good citizen and reduce your footprint, etc. And this is going to seem counterintuitive, but EVs can be fairly expensive and can also attract the new-ish luxury tax, so which is paid to the dealership on the purchase. And the word of warning is that if the EV car is not exactly what you wanted, I hope you didn't buy a lemon, but if you did and you wanted to return it, the luxury tax will not be refundable. So there's no rebate on that amount, and it would be a sunk cost. So that would be a bit of a surprise. Just speaking to the grants and incentives, another grant and incentive that could be accessible to you are some government grants for growing businesses online, which is, I think, up to about $2,400, or boosting technology in your business, which could be up to about $15,000. I mean, how you use this, the $15,000 is really meant to assist you in developing a digital adoption plan. I don't know too much of what anybody is doing that doesn't touch some sort of hardware or software or some digital component to their day in their business. And so with the plan in your hands, and once it's completed, the next question is, what do I do with this, and how do I put it into practice? And you may need some help to do that, and I think that's fair. And so BDC is arranging 5-year term loans at 0%. So the loan is arranged depending on some factors, and the loan could be for $25,000 up to $100,000 to implement that plan. So 0% over 5 years, pretty attractive, considering it's probably something that we're touching on a regular basis in terms of moving our business forward, growth or otherwise. So just how could you use this money? It could be simply even just making updates. That's when I talk about the day-to-day as opposed to coming up with a whole new strategy and changing your business to be a digital business. It's for everyone. So making updates could be buying equipment, could be more. The one thing that I think I'll remind or bring to your attention is that there is a defined window for the loan application to be done. So make sure you do your homework about the process before getting to work on this plan. Thanks, Josh. Go to the next slide. I think you went forward one too many. Thanks, Nat. I wanted to talk about dispositions of capital assets. I think. There we go. All right, I want to make sure that I know we're all reading from the same book, but it really does help if we're actually on the same page together. So now we're on the same page. Listen, capital assets, I mean, they've got their life and they've got their uses, and it's not an unusual decision to be making about when you want to sell an asset, right? So selling an asset that hasn't appreciated, that has appreciated in value in your business, you may consider delaying that. And the reason that you might consider delaying it from 2023 into 2024 is because it could provide you with a helpful tax deferral on the gain, right? So it would be taxed, even though you've sold it a month later, it would be taxed in a separate year. But you would have full use of the proceeds until that new tax, reporting and tax liability, tax payment needs to be made. It can also be attractive if you would like the capital cost allowance deduction relative to that asset. It can be just a timing difference in the deferral if there's a recapture of deduction on the sale. And just to expand a little bit on the idea of recapture gives you some context, is to keep in mind that, when you claim a deduction for the depreciation of an asset, when the asset is actually appreciating, going up in value at the same time, the timing for CRA to recognize that you should not have gotten that deduction because the asset was not in fact depreciating is when you dispose of it. So they recapture and take back deductions previously made in respect of depreciation, so capital cost allowance. So careful consideration really of what's best for you in your business, depending on the timing and what your objectives are. So lots of different factors. But while we're thinking of really disposing capital assets, dispositions of capital assets, I think it would be fair to also consider what's the right time to buy a capital asset. So for everyone who's disposing it, typically there's someone who's buying it. Josh, is there any similar consideration for the person buying, for the buyer, the purchaser?
Yeah, so for the person acquiring the capital asset, typically in the year you acquire the capital asset, you're entitled to claim half year of capital cost allowance. That's regardless of what point in time during the year that you purchase the asset. So if you purchase the asset later in your fiscal year, let's say the last month of your fiscal year, if you're a corporation, or the last month of a calendar year, if you're an individual, you're still going to be entitled to 50%. So the later in the year you acquire the capital asset, the greater advantage you have a little bit of getting an increased tax deduction in that first year. I'll just add to Natalie's comment about the sale of the capital assets, because I've seen this many times over my career. Natalie already commented on explaining what recapture is versus the capital gain. We'll just remind everybody with that the recapture is fully taxable and the capital gain is only subject to 50% tax. So I've had many clients sort of say, well, I sold it, and so isn't the whole gain, isn't it just 50% taxable? And we have to explain, no, whatever amount you depreciated it to. That amount up to its original cost is fully taxable. The amount over and above what you paid for it is taxable at 50%. So again, I would just encourage people to reach out to their advisors when the transaction occurs. If they're not sure, their advisors should be able to help them calculate that tax, because you're going to want to set aside those funds. So I see a question from Drew asking, is it advisable, recommended to claim capital cost allowance? The answer really depends. I mean, you're getting it, for the individual or the corporation, it's obviously a means of saving tax at the time. So, I mean, if you're going to be holding for a long period of time, it's saving you a fair bit of tax during that period of time. And so, using the time value of money and then having that the funds available to the company, or if it's individual, can certainly be beneficial. Depends. I will say it depends what tax bracket you're in. Often, sometimes clients might get caught where they're claiming the capital cost allowance when they're in a low tax bracket. This is more on the individual side. And then, as Natalie said, when you sell it, it's fully taxable. So in the year it's sold, so you might end up, having that recapture amount be taxable at a much higher rate than you obtained a deduction for. So again, you'd have to discuss with your advisor. I would suggest for a corporation, based on rates not changing, it's probably advisable to claim the capital cost allowance. For an individual, it's going to depend on the circumstances. We can move on to the next slide. Okay, accelerated investment income property. So again, another government initiative to encourage people to acquire certain type of clean energy type of equipment and certain equipment for the manufacturing and processing sector. So just basic rules are that any of the qualifying eligible property that was acquired after November 20th, 2018, and if it's in use before November 2028, will qualify. That being said, the benefits in general, again, for eligible property that qualify, and it'll depend on the type of property, but the deduction in a given year is anywhere from 1.5 to 3 times the normal deduction that's typically available. That's till the end of 2023. From 2024 to 2027, that's being phased out. So that same range of 1.5 to 3 that I just provided is going to be 1.25 to 2 times the normal deduction that you would have received. So there's definitely, for those in an industry where they may have property that they could acquire that would qualify, and there's definitely an advantage to doing so before the end of 2023, because as I say, it's being phased out a little bit through 2024 to 2027, and I guess fully phased out by 2028.
I'll add, Josh, that it doesn't apply to assets that are subject to the full expensing, right? So this is not immediate expensing, but similarly to immediate expensing, it's not going to change the total amount of deduction that you have over the life of the asset, but you're accelerating the deduction into the first year. So it allows for that enhanced benefit upfront. Next slide, please. Small business deduction. So this is not a new concept. It continues to be available for qualifying companies, which again, CCPC, Canadian Controlled Private Corporations with active taxable income. So active businesses. And what the deduction allows is it allows the company to have access to a lower overall corporate tax rate. So it's that active taxable income, that's $500,000 and lower. And the rate's holding steady at 12.2%. And so the amount above that attracts a tax rate of 26.5%. So, if you have more than 500, that's okay. The first 500, potentially you could have access to this lower rate, 12.2%. So that's very common. Really what this does, though, is it represents an overall deferral of tax between the corporate tax and ultimately the personal tax that gets paid when the dividend is ultimately declared out to the shareholder, which we touch on the next topic. So I won't get into that too much now. I also want you to keep in mind that if you have a group of companies that are associated, they need to share the $500,000 deduction. You do not each get your own, as it's my birthday, I can't give it to you, I don't have it myself, so must be shared. Now, the filing of each of those company is what really is the agreement between the companies in terms of sharing that small business deduction. Can get kind of complicated, and there's certainly an option for you to say, I filed this 5 times with you at 5 other companies, but this is the last one, and this is actually what it shall be. So lots of chances to finalize it and get it right. Also, I mean, the other thing, you know, something that is changing. So what I told you, none of that is new and none of that is changing. But there have always been considerations for taxable capital of each of the corporation. And the reason that that's important is because the higher taxable capital that you have as a group grinds down the small business deduction. So you can get all of it, you can get some of it, you can get none of it. And the number is really sort of that taxable capital range. So the upper limit is moving from 15 million to 50 million. So it's going to be eligible for more businesses, which really could mean, you know, savings up to about $26,000 or so in taxes, sort of at that peak, at the maximum benefit. Josh, I guess, do you have a reminder of anything new related to the taxable capital thresholds and how it'll impact the associated group, or anything else related to the small business deduction?
Yeah, I mean, I think you covered it relating to the taxable capital. As far as I know, it's for taxation years beginning on or after April 6th, 2022. So many would have experienced it before. For, I would say, for corporations that have a December year end, and as many of our clients do, they'll get the benefit of that for the first time for the December 2023 year end filing. I did want to comment on one other area that can impact your small business deduction, which again, for those with larger corporate associated groups are already impacted by and will continue to be impacted by. A few years ago, the government introduced the concept where if, as an associated group, you've got aggregate investment income, I call it adjusted aggregate investment income, between, once it's over 50,000 in a given year, up to 150,000, then that phases out the federal small business deduction limit. I think we've been fortunate that Ontario chose not to follow suit. So some of you may have experienced that already. And just going to some of our topics earlier when we talked about, you know, whether it's triggering capital losses or capital gains, again, depending on the size of your associated group's investment portfolio and overall company structure, keep in mind the impact that that may have, especially if you're triggering something that's a large amount, whether it be a capital gain or a loss. It does not apply to intercorporate dividends, so that's positive. So that, you know, that investment income is excluded from that calculation. But I've had a number of clients since this first got introduced who've been impacted by this. And essentially the government's position was, hey, maybe you don't need this small business deduction if you're able to defer the tax and move it aside and invest it and earn 50,000. And if you're earning 150,000 annually in investment income, then, you know, we don't think you need it at all. As I said, unfortunately, the Ontario government has not followed suit at this point.
Just one other thing relative to the federal and the provincial government. What we just keep your eyes open, I guess. So what we have seen is that when some of these tax returns are being assessed, they're assessing it as if Ontario and the federal have adopted the same thing. And so just keep that in mind, just so you're not assessed more tax than you actually are required to pay, and that you do have access to the small business deduction appropriately in both of those areas.
Great. Thanks, Natalie. Keith, next slide. Okay, getting your compensation strategy right. So this could be a webinar and a topic we could spend hours on, but we're going to just try to hit a few highlights here. Again, if any of those you have Canadian-controlled private corporations or have companies at all, you probably talk with your advisor about whether you should be taking salary or dividends from your company and what's the impact. And the decision for everybody may be different, and there's different. Every decision is pretty customized to your situation, so worth discussing with your advisor. But just hitting on a few highlights and things to be aware of, just in terms of the differences. So in general, the system is built that whether you take salary or dividends from your company, that the overall tax rate, corporate and personal, should be roughly the same. Where the opportunities come to benefit is if you're able to distribute, let's say, salary or dividends to a family member who might be in a lower tax bracket. Now, of course, the rules have gotten a little more complex, so it's not as easy to just do that as it did before. For salary, if somebody's earning a salary, you have to be able to justify the salary they're being paid, and to some extent, dividends would now fall under that as well. But for salary, I'll just comment that salary provides earned income. So for those who want to contribute to an RRSP, you need to have salary to create additional RRSP contribution rooms. Dividends do not qualify for that. For salary, for childcare costs, the lower income spouse is required to claim the childcare expenses, and they can only claim those childcare expenses against earned income. So again, if you have a spouse who's in the lower income, the only income they have is dividends from a company, they won't be able to claim those childcare costs. So that's another consideration. Canada Pension Plan. So the salary, again, you have to contribute to the Canada Pension Plan for that. And in order to obtain benefits later on, you are entitled to, there's a certain holiday period you can have that's in the calculation for when you ultimately obtain your Canada Pension Plan benefits. But in general, if you just compensate yourself for all years just through dividends, then you won't have contributed to Canada Pension Plan. Now that may be a good decision for you because there's contributing the employer portion to match that, so there's a cost to that as well. On the dividend side, there may be good reasons for taking dividends from your company for companies that have accumulated refundable taxes. The way to get back that refundable tax is to pay taxable dividends to shareholders. There's, it's gotten a little more complicated in the last few years with different pools, but in general, the company gets back 38.33% for taxable dividends that it pays out. And so if you're able to, if those dividends can be taxed in the hands of an individual who's going to pay less than 38.33%, then it may be advantageous to execute that strategy. Again, you have to be careful. There's a couple of different now pools of refundable taxes. So you could be in a situation where you declare a taxable dividend that will not generate a refund to the company and where the individual will still have tax to pay. Another just consideration is there's no requirement for any withholdings from dividends that are paid to a shareholder during the year. And salary, obviously, there's required withholdings for Canada Pension Plan and in many cases employment insurance and income taxes. Dividends, there's no such requirement, but what you'll find if it's the first year you've done dividend payments, you will have personal tax installment requirements the next year, assuming you're going to continue with that strategy. So again, very unique to each situation, and I'm sure something that should always be discussed with your family. I'll touch quickly on bonuses. Just a reminder for people with companies that bonuses can be accrued in a company, and as long as they're paid out within 6 months and the source deductions remitted to the Canada Revenue Agency, that accrued bonus can be deducted by the company as an expense in that period. So you can shift some of that. You can reduce the corporate tax burden and shift the tax burden for the remittances of the source deductions and the salary to the individual to another, possibly over a second calendar year. Natalie, did you have anything you wanted to add?
It's complicated. Listen, it's complicated, and we talk about it very, very quickly, and you've provided a lot of really, really great pieces of information and points, and some of it will apply to the people with us today and some will not, and that's okay. And I think the best piece of advice we can give today is to talk to your professional, because the details here will matter, of course. Can we hit the next slide, please, Keith? Alternative minimum tax, which I'm going to refer to as AMT going forward, because it's a bit of a mouthful. This is a sneaky one. And so you may have heard about it. You may know really well about it. You may never have heard about it and are curious about it. And I suppose the way that it's sneaky is that when you're working through a transaction that you ultimately result, you think it's going to be tax-free in the end, right? So tax-free funds. it's not always the case because, again, AMT can be a bit sneaky and actually is a tax liability that needs to be settled and paid. So when does this happen? So this happens, again, when you're using really an incentive. So whether you're using something like a lifetime capital gains exemption, or it could be something to do with, donating securities. So your tax is calculated in two separate ways in respect of the incentive. Okay, so as a result, you'll pay the higher amount between those two amounts, and the additional amount is considered this alternative minimum tax. Okay, so there is always a minimum amount of tax that's going to be paid. So don't get mad at the messenger. So this has been around for a while, but then it's changing a bit in 2024. But I just wanted to mention before commenting on that not all is lost. So the AMT can also be considered, in many cases, a prepayment of tax. So the tax that you pay in respect of that can be carried forward for a period of 7 years to potentially offset future regular taxes. Okay, so you really want to make sure that if you find yourself in this situation, be thoughtful that you may have a tax liability sooner, which might be a prepayment of tax. So you will work with your financial planners and your accountants to see how you can really make sure that you have the right kind of income and you have taxable, tax liability to use the alternative minimum tax prepayment going forward. And the changes coming in, again, beginning 2024. A couple of things, some good news and bad news. The good news is that, they're proposing that the AMT exemption amount would go up. And the not so good news is that increasing the AMT rate would happen, and broadening the base to which AMT applies is also going to be changing. So to give you an idea of that piece, it's like the capital gains inclusion rate under today's rules versus 2024 rules is changing, and same for certain losses, the ability to carry them forward has a declining inclusion rate, so benefit from that perspective as well. Listen, again, this can be really complicated, and it depends on your personal tax situation. It depends on the incentives that you're using. So clearly there's some consideration for some strategic timing relevant to the transactions. If you have time to do it in 2023 before the rules change versus pushing it into 2024. I think that the threshold, even though it's going up, is probably still at a level where AMT is still going to be caught on many of these transactions in the coming year. So, Josh, can you think of any other transactions or notes about AMT that people might not be aware of?
Well, I think you hit on them on the major ones. I mean, what I generally see, what I take from the new rules is essentially it's going to impact those in the higher income earners. So, yes, they raised the exemption, but the idea of the changes was to say it's really mainly those who are already earning a lot of income, and then they go and, as I say, sell their business and, use the example of utilizing your lifetime capital gains exemption. Those are the higher income earners typically that are earning that. And so, yeah, very important, because I said so many clients hear from accountants or read and say, yes, you've got this lifetime capital gains exemption. It's not subject to, say, regular income tax, but there's a good chance it'll be subject to minimum tax. And if you're just going from there to retirement and don't have a plan or a way of earning income to offset that liability that Natalie indicated carries forward up to 7 years, you may not recover all of that minimum tax. So it may end up being a permanent tax that you were not expecting. So certainly something to be aware of. And it's also going to affect, and I looked at the rules again, people are donating shares. It used to be that you donate shares and there's no capital gains tax. Well, there's no cap. There's a minimum tax capital gains inclusion rate with this new proposed legislation. So I don't know how the charities will feel about that, because it may discourage a little bit of some of the donation of security. So that's maybe one area before the end of 2023 where somebody may want to, who's being charitable and looking to donate shares that have a gain. That's something could probably be done before the end of 2023. As Natalie said, I don't think anybody's going to rush out and sell their business before the end of 2023 or make these changes make that decision based on these changes. We can go to the next slide, I think is our last one. Okay, so just a few reminders. Some of the reminders you'll hear from your accountants, from your investment advisors each year. But of course, the opportunity to make RRSP contributions and tax-free savings account contributions. So just a reminder, for tax-free savings account, the maximum contribution is going up to $7,000 for the 2024 year. There's a lifetime. If you haven't contributed your lifetime limit, you have that ability to contribute that as well. You can take out from the tax-free savings account at any point and repay. I think you do have to be careful about when you repay. You may have to wait till the next year to make that contribution again. Otherwise, you may have a problem with CRA. RSP contribution. So a reminder that it's always based on your prior year's earned income. So if you're looking to make a contribution for the 2024 year, that's going to be based on your 2023 earned income. So people maybe get confused because you can make your 2023 RSP contribution. The deadline is March 1st of 2024. I know many people wait till late to that last minute to make that contribution for the previous calendar year. One bit of advice I have for people is if you have the cash flow available, make it at the beginning of the year. You can make your 2024 contribution January 2024 if you have the available funds, and obviously if it's in your RSP and hopefully going up in value, then it's working for you sooner rather than waiting till March of each year. Also, just in terms of if your income levels varying year to year, personally, the amount that you deduct of your contribution, you don't have to necessarily deduct the full amount. So when I say that to people, it may be that that you're going to have a much higher income in the next year and a lower income this year. So you put the contribution in, you may choose to deduct some or none of it or all of it. But whatever portion you don't deduct, you can carry forward and deduct in a future year. So you're foregoing some tax savings if you choose not to deduct it all, but you may gain greater value by waiting that year and being able to deduct it from at a higher tax bracket. Charitable donations we just mentioned, and obviously, I mentioned investment advisors contacting you maybe about capital loss selling. You may hear a lot from charities this time of year reminding you that, hey, if you want to get a tax break, get your charitable donations done before the end of the year. So just a reminder that a pledge to a charity does not count. It has to be an actual donation and payment before the end of the year. And again, you've got to if you're not able to use it all in 1 year, you've got a 5-year carry forward period for donations. And I already touched on donation of shares. As I said, for this current year, you wouldn't be impacted by minimum tax. So whether that's in your corporation or as an individual, there's no gain for donating, securities that have an increase in that have a capital gain component to them. One last thing I'll remind people about before I ask Natalie if she has any further things to add. Installment payments. So, and general payments to CRA. I have a number of clients who maybe don't like to pay CRA installments if they're required, or may pay late. And in the past, the interest rates haven't been too high. Now, I'll tell you, CRA always charges more than what they pay in terms of refunding you funds. So typically about a 2% spread. And any interest that's payable to CRA is non-deductible. And of course, any interest you get paid from CRA is taxable. So right now, the current tax rates for corporate payments, I think pretty much almost all payments, CRA interest is at about 9%. And again, that would be non-deductible. And any refund that they owe you or they'd pay you interest, they'd pay you 7%, which would be taxable. So for those of you who don't like to pay CRA, I just advise you to take a second look at that and consider whether you want to incur a 9% cost that's non-deductible. And Natalie, over to you for any final comment.
I do not want to incur interest at 9% that's non-deductible and pay tax on the interest that they may pay me at a lower rate. So the CRA does not like being a bank, I guess, is their point, but it's very, very punitive and certainly more so today than it was a couple of years ago. Now, Josh, you covered a lot of things. I think we covered a lot of things all together in today's slides in the presentation. And just a reminder, I know there's been a question about will this be available if you've missed a part, if you've fallen asleep, which I'm sure you haven't, because we're as entertaining as we can be about this stuff, to please go to our website, www.ggfl.ca, and it will be available, I think, tomorrow. So this is, listen, the takeaway, there's a number of takeaways, but the big takeaway is that it can be complicated. The details do really, really matter, and to reach out to your advisors to have a personal conversation about anything that you've heard today, and maybe some other texts, or other reminders, considerations that may apply to you as well. Thank you. Thanks, Josh. Thanks, everyone, for joining us. And are there any quick questions? Because I think we still have a few minutes. Oh, I see. We do. I don't know if there's anything in the Q&A, but we do have a quick question about, again, it's compensation strategies, taking money out of the corporation tax efficiently to support income in retirement. The answer is yes. The answer is yes. So thank you for asking that question. It's a good question. We talked on some of those things relevant in the compensation strategy piece. Again, the details matter. So I think it's important for you to have a conversation with your advisor on the best, most efficient way to do that. Call somebody at GGFL if helpful. We would be happy to talk about it. It's a regular conversation.
I'll just add to that,
yes.
Natalie. I
Yes.
mean, I wrote an article on that recently that I believe is on our website. So again, there certainly is a lot of customization to it. So but it'll give you a lot of information that may help answer some of the questions you have.
Awesome. Thanks, Josh. That's great. I do not think we have any other questions, which is lovely for today. But at any point in time, if you do have any questions, you have your advisors, please reach out to them. We have a whole host of articles and videos and other information on our website, and constantly updating it. So that's a great resource. I still check it out myself when I want to refresh my memory about things. So please do take the time to have a look at that. And this video, again, will be posted on our website tomorrow. So I wish everyone a wonderful afternoon. Thanks for joining us. Bye for now.
Thank you, everyone. And happy birthday, Natalie, again.
Thanks, Josh.